Hello, I'm Paul Seabridge from JWD Capital Partners. We are building a game changer for the UK property industry and the global recruitment marketplace. Whilst this video is about those two sectors, the model that we're about to introduce to you can work in the majority of sectors. So before I tell you about the model, is this you? Are you looking to exit your business at some point in the medium term, maybe at some point in the next 2 to 5 years? Are you perhaps running a lifestyle business and have become a bit frustrated with the way that things are going? Are you looking to acquire bigger players in the marketplace? Are you looking to expand? Are you looking to roll up perhaps through acquisition? Have you got unfulfilled dreams, or maybe you're really ambitious and want to take your business from where it is today to new heights? In effect, our model allows you to list your business on one of the markets to create scale and liquidity so you can significantly grow and create some serious wealth. What we're looking for is profitable debt-free businesses that really want to scale and grow. To be profitable, we're really looking to target businesses that are generating a minimum of 150k EBIT right the way up to 5 million. That's our sort of sweet spot. Really, this model works with the management staying within the business and are obviously credible within the industry in which they operate. Exit is fine, but we would need to find other business that we could merge you with to make that happen. You need to be ambitious, you need to have stability, so it's not necessarily we need a business that has demonstrated year-on-year profit growth. We just need to see stable profits being generated over the last 3 years. You need to have a diverse business model, so looking specifically at the property market, we're looking for businesses that operate both estate agency and lettings rather than just being all in one particular space. So whilst it's okay to have a predominantly lettings business, we would expect that business to also have sales alongside it and vice versa. And finally, you need to have either audited accounts or accounts that could be audited. So what are we creating? Well, firstly, looking at the property model, we're looking to find 9 to 10 good quality, independently operated estate and letting agency businesses operating in major towns or cities around the UK. It doesn't matter what size you are, whether you have 1 office, 5 offices, 10 offices. And the idea is that these businesses will be best in class. They will merge together. So in effect, you will swap the shares in your current business for shares in the group business, which is the business that we would look to list on the market. And as a combined group, we will have a multidisciplined property related business. One of those acquisitions is likely to be a financial services provider, so that mortgages can be sold across the different subsidiaries. But what's unique about our model is that even the day after listing, nothing changes other than the ownership within the business. So each individual subsidiary carries on running exactly the same way as it does today. So you control the bank account, you control how the business operates, is managed, who you recruit, how you market yourselves, etc., etc. Nothing changes, which is unique about our model. Whilst there will be some economies of scale that would benefit individual operators, what we're not looking to do is merge a load of businesses together and then consolidate central functions like finance, marketing, etc. You've created a great business today, so why should we change the way that you operate? And of course, we need to leave something in the deal, so actually we don't want to make some consolidation, because as and when and if we all decide to exit this at some point in time, that's maybe for somebody else to look at and see a benefit within. So again, looking at the property model as an example, so these figures are obviously not correct figures. These are based on the model that we have an ambition to create, but it will be the figures that you see on this slide will very much depend obviously on the businesses that we bring into this model. So just using this as an example, example 1 shows one business that has fixed assets of 150k, net assets of 200k, turnover of £1 million, generating 200 grand's worth of profit, and manages 300 properties, property management, and is selling 300 properties a year. Now, if we found 9 other businesses doing exactly the same numbers, then that would mean that as a group we would have fixed assets of 1.35 million, net assets of 1.8, turnover of 9 million, profit of 1.8, and as a combined business we would manage 2,700 properties and be selling 2,700 properties annually. Now, of course, every business is going to look different, so we're not going to find 9 businesses all generating exactly the same. This is just for purposes of explanation. So we might have one business that may have a couple of offices managing 100 properties, to we might have a 10 office business that's managing 2,000 properties. But we believe that this model creates bigger is better. So in this instance you can point to the group services group when pitching for larger contracts, for example. So if you wanted to win social housing contracts or land and new homes or development contracts, well, you can go along as Bob from local XYZ estate agents, but you can point to the group company and say we're part of the UK Property Services Group PLC, which has net assets of 1.8 million and a turnover of 9 million, making a much more credible pitch. Using the same example in the recruitment world, we're looking for 5 founding members. So again, if we found 5 businesses all turning over 5 million, as you can see in this slide, as a combined unit, the numbers look like 750k fixed assets, net assets of 2.5 mil, turnover of 25 mil, and profit of 2.5, with probably each subsidiary managing anywhere between 200 and 500 contractors or temporary workers. Again, when pitching for larger contracts like IPO or retained business, you can still represent yourself as your local independent firm, but you can point to the Global Recruitment PLC with a turnover of 25 million, again, maybe making those larger contract wins easier and making your pitch more credible. So why are we doing this? Well, firstly, in regards to our people, we want this organisation to be a fantastic place to work. We hope that this will generate greater talent retention. How does that happen? Well, firstly, in terms of being able to attract the best talent, you can offer share options to people within the PLC, which are real shares. The difficulty of offering shares within a private enterprise is that they're not liquid, but an employee that's given share options can see what the share price is every single day. As a business that's going to scale, there's going to be significant future progression opportunities and amazing training and personal development opportunities that wouldn't necessarily be gained within a smaller enterprise. From a client's perspective, the idea is that we're going to create best in class from a client point of view. So I've already alluded to the fact that businesses can point to the group PLC to make pitches perhaps more credible, to win larger pieces of business. Obviously, all of these businesses, whilst they will continue to be independently operated by their current management, you will all come together probably once a month as part of an executive board to share best practice. So if one business is generating new customers for £200 a customer versus another operator that might be spending a lot more to attract a customer, well, obviously you can find out what the cheaper business is doing to generate new customers. So it's all about sharing best practice. We can create scale, and we're going to have the best people working within this business, but it means that you can also retain your own brand identity and brand retention, but can point to the group PLC as and when required. And why are we creating this from a shareholder's point of view, and what are the benefits to you? Well, the cost of capital within a small and medium enterprise, particularly in the UK, is very expensive. If you watch these programmes like Dragon's Den, for example, those really good pitches of existing businesses where they're raising maybe £100,000 or £200,000, they generally will end up giving away somewhere between 30 and 50% of their business. That's very expensive access to capital. What we're looking to do is offer 25% equity in the whole group, which is likely to generate in the property field somewhere in the region of about 5 million, in the recruitment world slightly more, probably somewhere in the region of about 10. So we've raised millions for giving away a quarter of the business. So the access to capital is much more liquid. It's a cheaper way to access capital. Clearly it's going to create wealth, and we'll come on to the sort of financial side of the model shortly. whilst I've said that we don't want to consolidate, there will clearly be some economies of scale that could benefit the group, and obviously we're going to have much greater buying power as a group business rather than as individual operators. I've already mentioned liquidity. The idea is that we will raise this capital purely for expansion and scaling reasons. So the idea is that post acquisition, the original 4 or 5 recruitment businesses will go out and buy 4 or 5 more recruitment businesses with the capital that we raise. On the property side, we can go and acquire lettings books that we can bolt into current operations, or we can go and buy standalone estate agency and lettings businesses. So the idea is that over an 18-month period we can literally double in size, both turnover, profit, and assets. It's a good exit strategy. Obviously shares are liquid, so they can be sold at any time after a lock-in period, which I'll obviously come on to as we go through this presentation, and of course it really does create wealth. So how are we going to do this? Well, firstly we need to recruit and select the founding members. We'll then agree terms. We'll carry out some due diligence, which I'll come on to later. Phase 1 is about merging everybody into an SPV, so special purpose vehicle. So we'll have a group holding company. You will swap your shares in your current business for shares in the holding company. That share offering will be based on really what you bring to the table. So if we had 5 or 10 businesses that all had exactly the same balance sheet, exactly the same profit and loss account, then of course everybody would be issued with exactly the same percentage shares in the group business. Obviously we don't live in an ideal world and every business will be different, so we will be able to give you an indication as to what that shareholding will look like before we obviously get towards the legal side of things. Once everybody's merged together, then we list the business. So I've already mentioned that the cost of equity to small and medium enterprises in the UK, privately owned businesses, is particularly expensive. If you looked to sell your business today in the property world, generally businesses are tending to change hands for sort of between 1.5 and 3 times the net profit. And in the recruitment world it's probably slightly more. You know, a trade buyer will maybe pay 4 to 5 times profit. Public companies in both spaces are trading generally between 10 and 20 times earnings. So the value of the group business is significantly more than the 1.5 to 3 times profit that you might achieve from selling the business today. So what happens after we list the business? Well, we will have appointed a group board, so that will consist of a CEO whose role will be principally around the strategy of the business as a whole, and focusing very heavily on making acquisitions. There'll be a non-executive chairman who will be almost the face of the business to the city, so will manage relationships with shareholders and investors and obviously chair the board. And there will be a chief financial officer who will be used to running a public company and all of the financial reporting and obligations that go along with it. In terms of who these people will be, they are going to be very credible individuals from within the industry with a great track record. But in terms of your business, you will carry on being the MD or CEO, and you will carry on running it exactly the same as you do the day after listing. So whilst you will be ultimately responsible to the group board, you will be a shareholder within the group business. So you will sit on a management executive committee who will meet once a month to share good ideas, best practice, and look at the strategy of the business moving forward, and be obviously heavily involved in making acquisitions as the business grows. So this is an example of the property industry. These are taken from November 2017. So this gives you the current price to earning ratios of businesses operating in this space. So at the lower end you've got the property franchise group trading at 10 times earnings, and then at the top end you've got Savills at 19.5 times earnings. So our model is unique in that in the property world, you know, the price to earning ratios is between 10 to 20. In recruitment, it's very similar, to be honest. So the typical market cap in both sectors are around about the 13 mark. We would normally list at somewhere between 6 and 9 times. So the reason that we do that is that we want to almost make the business on paper look really well priced. Because if we're going to offer 25% of our share capital to the markets, we want that share price to be oversubscribed before we list. So if we're technically seen as a cheap share in this sector when our competitors are trading at significantly more, hopefully we can get all of the shares, or the majority of them, subscribed to, which is going to push up the share price, because it's a simple supply and demand. If we've got lots of people that want to buy shares and there's not many around in the market, then that's going to push up the share price. So we can't really say what the market cap is likely to be in either of the sectors that we're doing this in, because it really depends on the size of the business that we merge together. So this, just as an example, in the property world, if we have profit circa 1.8 million and we list 6 times, then on day one our market capitalisation is 10.4 million. That's what the overall business share capital is worth. So there is some flexibility in this, but we would anticipate that the management will retain somewhere between 65 and 75% of that share capital. So in this model, the original founding members combined will own £7.5 million worth of equity. And the free flow is the amount that we offer to the market. So in this example, £2.5 million will be offered to the market, which is what we will use to go and acquire other businesses. The numbers on the recruitment look probably around about double, possibly triple these numbers, just because the size of the businesses that we're looking to bring into that are going to be significantly larger than the estate agency and lettings businesses. So pre-IPO, if you've got friends, family, acquaintances that want to get in on the action, then they can do that before we actually float, so they can actually buy shares out of that free flow before we list. As I've said, the idea is that we oversubscribe the shares, which pushes the price up. So even if we just took it to 10 times earnings, well, you can see there in this model we've gone from a market cap of 10.4 to a lot more, and if the management have 75%, well, they've literally doubled their shareholding to sort of around the 15 million mark. So what happens post-acquisition? Well, the idea is that you can go out and buy other businesses. So in the property model, you'll go and buy either a lettings book that you can bolt into your existing operation, so almost you're buying turnover and profit, or you're buying standalone estate agency and lettings businesses that are debt-free and profitable. On the recruitment side, exactly the same. You're buying other temporary and contract recruitment businesses that are either a sort of vertical market or horizontal. So maybe you want to, maybe you're an IT recruiter and you want to go and recruit sales, then you would go and buy a sales recruiter. Or if you want to buy more market share in the IT recruitment space, well, maybe you'll go and buy an IT recruiter outside the UK, so you can expand your global coverage. So looking at these two models, here's just a very quick example. We started off in the property business with 9 initial businesses. Maybe we've made 5 acquisitions since. So basically you can see the effect on the balance sheet. We're taking the business from where it was to more fixed assets, more net assets, more turnover, more profit, more managed units, more house sales. So we've increased our market share through acquisition. So the acquisitions should pretty much pay for themselves. Looking at the recruitment model, again, if we've gone from 5 founding members to 10, then again we've increased our turnover, profit, net asset base, and the number of contractors and temps that we have out working every week. So post-acquisition, the effect on the share price, obviously nothing is guaranteed, but if we've priced it right, we've priced it competitively, we start making acquisitions, we're going to become a business that is a low-risk investment. We're raising capital, we're using that capital to buy other businesses that are profitable, so we're increasing our market share, we're increasing our earnings, which is going to have an effect on the share price, hopefully in a positive manner. So if you look at those examples in the property business, if we buy another 1,000 units under management and each of those are paying us £70 a month to manage the property, well, we're generating a significant amount of recurring revenue. Exactly the same in the recruitment world. If we're buying another 5,000 temps out every single week, then we've got that long-term contracted recurring revenue, so it's really going to become a cash flow positive liquid business. And because that we'll have economies of scale and businesses that operate in certain markets that maybe the next business doesn't, we can hopefully increase revenue also from cross sales. It's about expanding the offering, expanding the geography, really scaling up this business, and of course it becomes a very liquid business. Improved financials will equal an improved share price, which improves liquidity. So to get started, we obviously need to talk to you and understand your business and check that you are the right sort of business that can be part of this organisation. In terms of the next steps, we have that initial meeting. We can't give you an offer until we've done some initial due diligence, so principally that's around the financial side of things. We then make an indicative offer which will be subject to full due diligence. So the full due diligence really consists of legal, financial, executive. So the legal, we're looking at all the legal sort of agreements with your current business. We're looking at employees, contracts of employment, leases, for example. The financials is to really check that all the finances stack up. And then from an executive point of view, it's making sure that the people behind the business are credible. So we can talk when we meet with you more detail about how that happens. Due diligence usually takes between 3 and 6 weeks. It's more dependent on you rather than us. It's really about how quick you can provide our team with the documents that we request. So it can literally be done in a matter of days if you've got access to everything we need straight away, but it might take more realistically somewhere between 3 and 6 weeks. Once due diligence is completed, we'll confirm the offer, we'll draw up the legals, everybody will merge, and then we will list. In terms of timescales for doing this, from that initial meeting to conducting due diligence and making an indicative offer, it's probably somewhere between 4 and 6 weeks. To complete the full due diligence is probably another 4 to 6 weeks. The legals and the merger will happen thereafter, and then the listing will normally take place between 60 and 90 days thereafter. So we're looking really at sort of somewhere between 5 and 6 months from today, you deciding that this is what you want to do with your business moving forward, to actually being listed on the markets. In terms of a lock-in, if you're not exiting immediately, we would normally expect people to be locked in. So basically you can't sell your shares for a period of 12 months. That's very common in most markets around the world. And obviously, if you are looking to exit the business there, within that sort of time scale, then it gives us some time to succession plan what happens after you cash in and move on. But equally, if you wish to carry on after that lock-in period, well, nothing changes. You carry on running the business, you carry on making acquisitions, we carry on growing the business until such point as you decide that it's time to go off and do something different. So if this model sounds something that you'd like to explore and find out more about, this is my contact details, so you can email me, you can call me on my UK mobile, you can WhatsApp me, you can visit my private equity firm website for more information about this, but really the next stage is to get in touch and we can have a chat about your business, your ambitions, and see whether this is the right model for you. Thank you for your time.